Hello everyone, welcome to the newsletter for November 29th. It's going to be a little bit low tech today. I'm currently in the process of moving flats. I don't have all my equipment set up, so it'll just be me and the mic for this one. But what I wanted to talk over is just some of the thoughts I've had running through my head and some of the recent events that are certainly non-trivial in nature and how they relate to the crypto market. So it's going to be a bit of an overview of a few different tweets that I've seen over the last couple of weeks. A few different concepts and ideas that have come out, and just giving you at least my thoughts and a bit of a heads up, because there's some fairly substantial moves being played, in particular in the regulatory space and counteracting privacy and things like that. So I just want to give you my thoughts. And again, I'm always just trying to absorb as much information and listen to as many smart people as I can to really build up my view. I'm by no means a professional in any of this kind of thing. It really is an observation from the outside. But certainly when you're dealing with things like regulations and privacy and just trying to wrap your head around as a layman what it all means, it can be quite a challenge. So, I just want to kind of provide my perspective on where I think things are going, what some of these recent maneuvers or updates kind of mean longer term. And just a bit of a mental framework about how I'm thinking about things. So there's a few things we'll touch on. We'll talk about the kind of state of global macro and what the current everything bubble kind of looks like. We'll talk about some of the moves into central bank digital currencies and what government plays are being made. There was an announcement by the US Treasury regarding self-hosted wallets. They've now renamed from self-custody to self-hosted. So we'll talk about the implications of that. And then just some of the tweets that, in particular, Raoul Pal's really been kicking the hornet's nest of Bitcoiners and stirring up them in terms of, the nature of financialization and KYC and all this kind of stuff. So we'll talk about global macro. So this was also inspired by a Raoul tweet where he was contemplating, I think it was on a Friday, he was contemplating what the macro trade really looks like. So for those who may not be overly familiar, the concept of macroeconomics is very much looking at how the global gears all fit together. How do all of the different markets, as they talk to each other, and what are they signaling? What do they mean? How does the Forex market interact with the bond market, interact with equities? In general, macro trades tend not to be super deep in the weeds of equities. They tend to look at equity indices. So they're looking at the relative performance of a nation or comparing different parts of the world. They're not so much interested in individual stocks. There's a handful that are kind of, Tesla's a good example of a trade that's kind of in a macro sense because it's one of these emerging renewables and energy and hype and narratives. And, Tesla's one of these great example stocks of cheap money, great marketing, a front man who can sell a story, all the rest of it. It surmises what's going on in the fairly loose monetary policy regime we're in. But macroeconomics, it doesn't go into the weeds of individual stocks. It more looks at the large scale things like interest rates, things like bond rates, when you're getting dislocations between those markets, where the bond market is telling you a very different story to the equity market and so on and so forth. And what Raoul's tweet was essentially saying is and there was a number of, if you listen to the Macro Voices podcast, which I highly recommend, anyone who has an interest in macroeconomics, it really is, besides Real Vision, it is the best other source for macro level information. So it's certainly one to be keeping track of. That's the Macro Voices podcast. And many of the guests that come through there, the Luke Gromans and Brent Johnson, and these guys, Mike Novogratz, these kind of guys who think about these very big picture things and are fairly outspoken about it. They're fairly common guests on it, and they were all essentially commenting the same thing as what Raoul was saying, is that they think there's going to be about a 3 to 5 year period of just insane macroeconomic moves as we go through this fairly substantial transition that I'm sure that we're all kind of seeing unfold in front of us with, zero bound interest rates, the money printer goes burr. We're seeing all of these things kind of coming to a head. We're at the end of the everything bubble. So they were philosophizing there's going to be 3 to 5 years of quite significant macro movements. But following that, they're kind of talking about the death of macro or the end of the macro trade. So to put a bit of context, at least from my own perspective on what that means, and obviously inspired by some of these great thinkers, the concept is that we're now moving to a stage where the debt is simply too big. It is just too big. This is the same for at an individual level. So you'll hear a lot of people talking about student debt, medical debt, The need of pension funds to pay for baby boomers' retirements. There's just debt everywhere in the system at an individual level. In Australia, we've got the biggest mortgage bubble that we've ever had. Switzerland's the same, huge mortgage bubbles, student debts. There's all these things that are debt is a huge weight on people's ability to spend. So the need to actually pay back debt is a deflationary process, because when you're paying off your debts, you've essentially spent that money yesterday and you're now paying it off today, which means that you're not buying something else today. So the stuff that you're paying off in debt is essentially not becoming someone else's income today. So it's a deflationary process. So the more people are paying off debt, the more deflationary the overall system is. And in a deflationary system, then people can't pay off their debts, because what the reality of deflation means is that incomes and wages and various things will come down, because obviously less people are spending, and that means that it's harder to earn money tomorrow than it is today. So if you already have a debt, it becomes harder to pay that off. So if you amplify that across the population, where you've got lots of people with debt, you've got corporations that have record levels of debt. So not only is it the individuals, it's the corporates. In 2008, that really was the implosion. We saw the banks that were just too over-leveraged. And in many parts of the world, particularly Europe and increasingly in the US, many of the banks are right back where they were, if not worse off, in terms of debt levels. So, and it's not only the banks now, it's actually corporates. So it's gone from an individual housing bank problem in 2008 to all of the banks. It's gone to all of the, many individuals. It's gone from household up the chain. And we're now at the point where the amount of debt is, it's national now, essentially. So much of the debt failures that occurred in 2008 essentially rolled up the chain and became the central bank's problem. And what we saw in 2018 is that when they started trying to offload stuff from their balance sheet at the Fed, and essentially trying to unwind some of the debt that they purchased in 2008, the market couldn't do it. It just couldn't absorb it, and it had a dummy spit and sold off in December 2018. And for me personally, that's when I started to really start thinking maybe we are in a bit of trouble, a bit of hot water here. So I actually sold most of the equities that I held back in December 2018, thinking that was the top. And ultimately we kept rallying, and being early is just as bad as being wrong. But ultimately, that was the point when I started seeing, and I'm a fairly relative scale, fairly uneducated person at that point in time. At least I'm certainly a lot better off now than I was. But I certainly didn't understand the magnitude of what was going on. But I felt like something was wrong. Right? You felt it in your bones. And we're now at this point where the debt level it's now a sovereign debt crisis. And we're at this position where, equities are at all-time high valuations, PE ratios that just make no sense. Companies have to operate for hundreds of years in profitable territory to pay off to justify and pay off their current PE ratios. You've got the bond market that's gone from 17% back in the 80s, which was, and for those who don't know, bond prices are inversely correlated to bond yield. So when you have a very high bond yield, the prices are low. So if you bought bonds back in the 80s, you would be getting 17% on your money, plus you would have been buying them dirt cheap in relative speaking. And ever since that point, we've essentially had interest rates coming down, right? So they've come down from 17% down to the lower bound of zero, essentially. And they just look like they're never, ever going to creep back up. So it looks like the zero bound is now the permanent state for bonds, for sovereign bonds. And that essentially means that if you had bought bonds way back and just held them, the price appreciation as bond yields go from 17 to zero means that the price goes from dirt cheap to extremely expensive, because they're inversely correlated. So the bonds are now at record level valuations and yielding nothing. So if you factor in any kind of inflation, your real return on a bond is negative. So you've got negative yielding real rates on bonds. So the bond trade is more or less done. And we're also now starting to look at central banks that have to essentially create digital currencies, right? Because we now have this enormous debt problem. And if they try to raise rates to recuperate some of that cost of living, think about the maker system when they want to stop people taking on debt and stop inflating that system. They raise rates to make it more expensive. But the problem is that the central banks do that and the market has a dummy spit. So the central banks and the governments of the world are very much in a rough spot where they cannot move monetary policy anymore. The interest rates are essentially fixed at zero, and there really is nowhere left for them to go. They can go negative, which just has all sorts of savage ramifications that they've tried it in various parts of the world, particularly in Europe and Japan, and it just doesn't work. It creates a whole host of new problems. So they can't do anything on the monetary sense. And we're now in the realm of fiscal policy, where essentially it's print the money, buy the bonds, and spend it into the economy, right? Just give people money. And unlike 2008, where it was essentially bail out the banks because they were over leveraged, it's now a case of trying to bail out not only the banks, but also the individual. So, notions of MMT and UBI and these types of things are starting to float around. CBDCs, or central bank digital currencies, are a vehicle that enable this to happen. But what that really does is it essentially kills Forex markets. So there's a very real possibility that what's going to come out of this whole thing, the IMF is talking about a new Bretton Woods system, and that would essentially look like a basket of currencies, a Libra type system. It just happens to be dictated by central banks. So, we could very well see this amalgamation of many different, like a basket of currencies that get stuck together, and the FX market may very well come to an end. So, we're not only looking at the end of the bond market trade, we're looking at the end of the Forex market, which is, $4 trillion a day globally. And we're seeing the commercial banks who currently, if you're a customer or you're a citizen, you would have an account with your local bank. There's normally a handful of bigger banks and then local ones around. And then they have an account with the Fed or the central bank. If we move to this world of central bank digital currencies, which looks to be the way that we're headed, essentially you as an individual or you as a citizen would have an account with the central bank, and it essentially completely disrupts the commercial banks. So you now have this whole sect of the economy, the banking system, that is essentially replaced by a digital ledger. So, we're at the end of this very, very large macro trade where there's going to be a whole bunch of years of just complete chaos and things moving around and changing and evolving. But then many of those markets that have really been driving things for the last 50 years essentially dissipate to nothing. All right, the bond trade goes away. The notion of Forex markets will completely change. I think this bodes well for the digital assets becoming a new macro trade. I think things like huge pushes into things like renewables, and I know Mav touches on a lot of the, kind of that forward thinking, where do we take society? And that's more of an equities type play. But essentially the field of economics that these macro traders like Novogratz and Raoul Pal and Dan Tapiero have all traded, it's probably going to be a very big commodities bull run. And then it's going to go to a whole new industry. They're saying that it's almost going to be over. The Forex trade disappears, bonds disappear. So it's going to be a very interesting couple of years. And, these guys, their job and their profession is looking forward and trying to understand what is the most likely, the most probable outcome. And what they're essentially seeing is it's going to be complete chaos. Things are going to be changing. There's going to be transitions everywhere. And then all their markets are essentially going to dissipate because we're just moving into this brave new world of what probably resembles an MMT type scenario. And, ultimately what that means, if you're looking at it from our perspective, what that really means is that currency debasement is going to become, that they would rather sacrifice the currency, and by they I mean central banks and governments. They would rather sacrifice, or they have to, is probably a better term. They don't really have a choice. They have to sacrifice the value of the currency in debasement by printing it. Because if they allow equity markets to fall, if they allow, they have to exercise yield curve control to actually manage the bond rates, because otherwise they're going to blow out and get, bond rates just cannot be set higher, right? The market, if they want to set the bond rate higher, the world just cannot sustain higher interest rates because the debt levels are just too high. So they're going to have to exercise yield curve control, which means they just keep buying bonds. As we said, they're inversely correlated. So if the price of bonds falls because people don't want to hold the debt, then the yield goes up, right? So price of bonds fall, people don't want to buy it because debt's toxic. And the central bank will then step in and bid and keep the prices of bonds high in order to maintain those zero to almost no interest rates. So that's what's called yield curve control. So, essentially the central banks are just going to keep consuming these bonds. And essentially when that risk, when you lend someone money, that's you taking on risk. The risk is, will they repay you? ultimately, if the central bank is just becoming the inevitable buyer of all debt, then there's no risk in the market, right? People can just lend and borrow with almost no recourse because they know that the debt can never be repaid. And in order to buy that debt, the central bank just prints and prints and prints. So ultimately, they cannot allow the bonds to fall because the system can't handle it. They can't afford equities to fall because there's just too many people whose retirement is reliant on equities. So we could see these very unsustainable and very artificial pricing levels for a very, very long time. And the ultimate loser in that whole scenario are people who hold bonds and people who hold currency. And this is really where we're moving into this, commodity bull run, this secular commodity bull run that's most likely going to be led by gold and increasingly by Bitcoin. That's essentially just a scarce asset. It represents value that people actually need. Whether you're doing infrastructure projects as a nation or a corporation, you need actual tangible assets, consumables, materials, things to actually build and develop and create. More of this is going to start shipping online. So there's going to be a commodity side to this whole thing because quite often during deflationary periods, governments will spend money on infrastructure because it's kind of an investment in the future, building road, rail, and things like that. So that's where your commodity boom will come from. But there's also this huge shift, and we're all involved in this digitization of the world and this creation of new types of equity. Which is why I think DeFi is it is a very interesting trade because it's almost creating a new type of macro. It's a new place for all of this to exist, new financial systems, new primitives, and really taking things into the next level. And it's going to evolve across many layers. Like DeFi is clearly captivated in Ethereum. There's going to be other chains that start to develop it. There's things like DEXs and various other implementations that are being built that are outside of the Ethereum space. And technology rarely slows down, so we're only going to see more of this playing out. But ultimately, at the end of the day, we're going to head into this interesting world where people will have accounts with their central bank. Government will have more control over money in the way that markets operate. And, I think what's becoming increasingly clear, and this is another tweet that Raoul put out that really triggered the Bitcoin space, is this government control over money has a yin-yang effect with privacy. So maybe yin-yang is the wrong terminology. It's actually it's more of a spectrum or a trade-off spectrum. So, if you have financial privacy, let's just say, for example, we have a Monero level privacy, it's very, very hard for the government to have control over that system. The complete opposite side of that spectrum is a central bank digital currency where the government has full control and full access to all of those transactions. Bitcoin sits somewhere in between those, and Ethereum and Bitcoin really are kind of one-to-one when it comes to privacy, aka it really doesn't exist. And what they can essentially do is take any KYC information from the exchanges that people buy the coins at and essentially map that to any address. And what we saw this week, so Coinbase released a very interesting tweet in response to Steve Mnuchin, who's the US Treasury Secretary. He announced that they want to introduce what's essentially called the Switzerland rule, or when an exchange is withdrawing coins. So this is for US customers, but as we know, much of the world will follow US regulation, so it is important to be aware of this. Mnuchin basically said that if an exchange is going to withdraw, or you as a customer initiate a withdrawal, Coinbase needs to verify, or a US institution needs to verify that the address is owned by that person. So they've already implemented this in Switzerland. So it's essentially making sure that every single address is truly KYC'd. There's a few more things floating around. I forget the four-letter agency, but one of them was saying that they're going to reduce the from $3,000 to $250 the threshold at which institutions need to be sharing KYC information. So if you send coins from Coinbase to FTX, both US institutions, then they both, if it's $250, they need to be sharing KYC information. And the crypto industry is really not developed for this. The traditional finance system is, you've got traditional banks that do this all the time, and all they do is change a number to go from 3,000 to 250. But in crypto, most of the exchanges and systems are just not set up for this, because we know that once you transfer coins to a wallet, then what happens if you send them to another wallet? Who do you have to verify that information with? And the whole thing really goes against the ethos and the value proposition of it being freedom money. So there's this interesting counterbalance between what regulators want and what we probably want, which is a bit more privacy, a bit more freedom, and a bit more, control over our money. Whilst at the same time, there's this tension being pulled where central banks want to introduce CBDCs, which essentially give them complete custody over your money. They can choose where you do and don't spend it. And obviously, all of this varies depending on your jurisdiction. It's going to be different in Australia than it is to the US, to Europe, and throughout Europe. It's going to be different all over the place. But the general trend that we're seeing is towards more control, not less. And it's a challenge. And Raoul put out a tweet that triggered everyone. It's basically saying that if you expect Bitcoin to exist without KYC and regulatory oversight, almost to a transactional level, then you're kidding yourself. Now, I think that this triggered Bitcoiners because they all probably realize that that's true and they're not happy about it, right? I'm not pleased about it, but I do think that the financialization of Bitcoin, and I think Ethereum as well, I don't think they're going to be allowed to exist and thrive without regulation to the nth degree. Now, there's multiple ways you can look at this. It's kind of an inevitability. I think it's good for price because the more that these things get financialized and integrated with the traditional system, the more use they're going to get. Raoul is right that this is what adoption will look like. It may not be the libertarian view that everybody wants and desires, and it probably won't be the best thing for censorship resistance and many of the value propositions of these tokens and these networks. So it's not an ideal scenario. But these macro traders, they're not in the business of looking for ideal scenarios. They're in the business of looking for the most probable outcomes. They look for probabilities and what is the most likely thing to happen. And I do agree with him that we are most likely to see Bitcoin and Ethereum in particular becoming increasingly financialized, which is great for number go up. However, there is a trade-off here, and that is that we're essentially, and by we I mean, I guess society, but at a broader level, that financialization and number go up comes at a trade-off that it's going to become integrated with the financial system, and KYC is most likely going to start appearing at every entry, exit, and intermediate hop. I don't think that trend is going to slow down. So, it is a challenging scenario because I'm sure that many people listening to this probably subscribe to something similar to my view, which is that we would prefer a world where we can have bearer assets, we can have more freedom from governments. And granted, it still is an upgrade. All right, it is an upgrade to have a bearer asset. But the risk is that if they introduce there's the travel rule, which is the $250 thing, and then there's the if you withdraw to your wallet, you need to KYC, or the Switzerland rule. If they do this and they actually bring this in the US, it is most likely to follow throughout the West. It's going to push more people into offshore exchanges, and what it is going to do is it's going to come to a point, and I think a lot of Swiss exchanges have done this. They just said, you know what, it is too hard for us to comply with laws to allow people to KYC. How do we verify that wallet is in fact yours? It's just such a challenge. We're just going to stop doing withdrawals. So that's kind of where I see the outcome of this. That will stifle innovation. Someone on Twitter was saying that if you deposit funds into a smart contract on Ethereum, so say you deposit into Maker or Compound, technically Maker and Compound smart contracts, in fact all smart contracts, are custodial. So you have now transferred your coins from Coinbase to yourself. You've verified, yes, this is my address. But then you go and deposit those coins inside Maker or Compound or Aave. You have now handed over the custody of your coins to a wallet that you don't control, and you cannot provide that KYC information. So now you're creating this the governments create this very complex web of, it actually becomes very challenging, expensive, and almost impossible to comply. And unless you start overlaying KYC interfaces on the front of DeFi protocols and not allowing people in, you can see very quickly it starts to become quite onerous. And, ultimately governments are not really in the business of thinking about things from the most sensible perspective. They tend to implement what they think is going to give them more control and more surveillance and, money laundering and all that kind of stuff, trying to control all of these edge cases. So, this is kind of where I see these things going. I still think it is beneficial for number go up. So if you're looking at this space as an investment type thing, and number go up is really what you're here for as a trader. That side of things, I think, is going to remain a very positive move. I think global macro is going to shift into the digital macro. I think that we're going to see increased financialization, which becomes adoption, which becomes easier access, becomes ETFs, all of the above that people have really been looking for with number go up for a long time. I think that's probably all going to happen. So, from a fiat gains perspective, thumbs up. From a privacy and self-freedom perspective, we could very well be up against some challenges. Again, no one can really predict the future, and a lot of this stuff is quite hard to decipher, and you have to rely on some of these crypto lawyers on Twitter who do a very good job, actually, of trying to keep people informed of what it means. But, for Brian Armstrong from Coinbase to come out and say we actually are quite concerned about this particular ruling by Mnuchin. Granted, none of it's not law yet. It's got to go through all the hoops to actually get there, but the fact that there is momentum on this it's kind of indicative. So it is something to just be aware of. Again, I think we've all been aware that this is probably the direction things are going to go. I don't think anyone should be really surprised about this, but it certainly brings it to the front of mind. And I think it is an uncomfortable thing to have to deal with, the thought that we may have to be KYCing everything, and things really do start to move into a not so great Orwellian type landscape. Granted, it doesn't necessarily mean it's all bad, right? We still have to see how it all plays out, and I try not to think that it's overly malicious on the role of governments, but it's certainly something to just be aware of, that this is kind of the direction things are going. Regulators are slow-moving beasts, and they tend to apply very large blanket rules until there's a pushback that makes them actually wind it back to some kind of common sense level. So there's this very interesting tension between financial privacy and self-sovereignty and freedom, and financialization and number go up. They're the two kind of pull and shove side of things. And we've spoken in previous newsletters where we've kind of touched on this realm where I think Bitcoin and Ethereum and DeFi sit in this financialization side of things. And then there's another sect that's kind of the Decreds, the Moneros, the Havens. In the podcast recommendation that I'll talk about in a second, they talk about this bifurcation of the market where you could very well have self-custodied, out in the open, out in the wild Bitcoins, and coins that are essentially held all on custodial systems. So if the Switzerland rule was to come in, they stop doing withdrawals. Eventually coins will get pulled in as people sell them, and once they go into an exchange, they kind of don't leave. So there's this mass accumulation of coins on centralized infrastructure, and because they then can't be withdrawn, it's effectively a 6102. As soon as someone wants to go and sell it to take their fiat gains, they essentially go in and they don't come out. So, these are just some of the things to be thinking of. I still remain very bullish on Decred and Monero for that self-sovereign. Essentially, they're the only project that are taking this seriously. Now, that comes with a huge caveat that taking freedom and privacy seriously comes with very real trade-offs in a world that is most likely to become financialized. So whilst those two projects are exceptional in quality, code, cypherpunk values, and I couldn't be more bullish on them, I'm certainly not bullish on them necessarily for a fiat gains perspective, because as we're seeing with Monero and Zcash being delisted, Shapeshift is a good example. Eric Voorhees is a libertarian, right? He loves privacy and freedom and self-sovereignty, and his company is delisting privacy coins. So it gives you a bit of a flavor as to, this is not going to be an easy road. Some of these projects are going to have an uphill battle. I personally think Decred's done a good job at being that auditable chain. So, it remains flying under the radar for that perspective. And whilst many of these other privacy coins like Dash are being removed, essentially Decred is doing nothing different to what Bitcoin has done. It's just coin joins that just happen to be effective. But, there's no given, right? It could very well come up against the same issues. Thankfully, at least it has the governance system to actually evolve and change. And, again, things can adapt to the needs of the project. But, I certainly look at those as probably the only two projects that are taking the freedom and the sovereignty side very seriously. I consider them to be an insurance policy, and I think that should that insurance policy be required, it will be repriced quite substantially. In the meantime, we're going to go through a period where I think Bitcoin and Ethereum and the like are going to become increasingly financialized, good for number go up, really not good for privacy, and most likely going to head towards increased centralization rather than decentralization. So there's a lot in all of that, and I know it's kind of been me rambling and just talking about what's in my head, but it's kind of the direction I'm seeing. I'm seeing some of these very smart guys talking about the real changing macro landscape. They're all super bulls on the digital landscape, and they're in the industry of looking for the most probable outcomes, not the most likely, best libertarian, happy days, freedom variables. They are really looking at what is the most probable outcome. And really that looks like central bank digital currencies. It looks like currency debasement. So, and it looks like financialization of these crypto assets and essentially integration with the traditional finance system. And that does mean regulation. It does mean KYC. I think it will still be better than what we have today. It will be more permissionless, so it will most certainly be better for people outside Western jurisdictions who have no banking infrastructure. It will most definitely be better for them, particularly if scalability gets better and they don't get destroyed by fees. So I think overall it's going to be better. There's certainly some challenges around privacy to come, and many of the advocates and lawyers and the like in this space are certainly wary and conscious that it's going to be a bit of an uphill battle. I think the industry is, it's full of some of the smartest people in the world, and increasingly we're seeing people who are pro-Bitcoin or pro-crypto, or at least not against crypto, moving into positions of power, and that will certainly help as, that they start setting rules and getting common sense in. And as with many things in life, often time is the best healer. And with increased time and distance and people coming in and fresh ideas, hopefully we head down the right path. But the notion of a debt jubilee and fairly massive printing of fiat currency is going to be there. I think it's just going to bode so well for Bitcoin and gold in particular, essentially any kind of scarcity. But the shifting global macro landscape, it bodes so well for this industry as a beneficiary of this whole fourth turning playing out. So, I'm strongly convinced that we are extremely early in this trend. I think it's the right technology, the right place at the right time. I think understanding the trade-offs that are most likely to happen is important. And you can then, you can update however you view the world and view these markets and your investment portfolio and theses in line with what is the most probable outcome. So, this is just kind of my thoughts on where we're headed. And if you want to understand a little bit more about this, I would definitely recommend, there was a recent podcast on the Unchained podcast with Laura Shin, with Jake Chavinsky, and I forget who the other lady was, but they were talking about a lot of this stuff, the notion of privacy. I think it was on the 17th of November. So they were talking about very much what I've just kind of talked about, is that tension between privacy and where governments and regulators want to take these things. They certainly talk about some of the challenges that are upcoming, but they also, they're relatively optimistic. But there's certainly some steps that, the Steve Mnuchin maneuver, for example, which I can't quite recall if that had happened. I don't think that had happened when they had done this podcast. So that's actually something that further alludes to the fact that it's going to be an uphill battle. I think it was the $250 travel rule that they introduced. So they talk about that. And they give it a little bit more context, so just to help you understand it. But it's certainly a worthwhile podcast to listen to. People who are familiar with the legalese and how all of these systems work and the negotiations and how regulators work. It is great to actually hear Jake and others talk about it, because you get to hear what the nature of the beast is behind the curtain, and it gives a bit more insight to it. But anyway, that's kind of my ramblings for the week. There's a lot going on. It is very interesting seeing this macro trade playing out. The financialization is fairly likely. But I think it's the right industry. Crypto is at the right place at the right time. And I think Bitcoin is going to be absolutely a beneficiary of it. And I think that DeFi is well positioned to really capture this shifting global macro narrative. So thanks for putting up with just the audio this week. We're back to regular programming. Should be all set up for next week. And I'll catch you in the chat rooms and catch you in the next Omnia call. Cheers.